All right, welcome back to the Dynamic Growth Podcast. My name is Nate Crosby, and I'm joined with Derek Ballinger. And today we have a special guest on the show, and that is Doctor of Chiropractic, Andrew Bang, who is also a real estate investor. And a lot of our clients have asked, how do I add real estate to our portfolio? And that's kind of what I wanted to get into today, because Andrew, you have been a successful real estate investor for how long?
Well, thanks for that, Nate. Successful, Nate and Derek. I'm super happy to be here. I was just going back through my mind since 2011 was I bought my first rental property.
Okay. And that's about how long I think we've known each other.
Oh, yeah. It is actually how long we met. That's when we first kind of started interacting.
Before I got on this podcast, I went and took a look at the first insurance policy that we pulled out, and it was about 10 years ago.
Perfect.
So everybody, if you enjoy this episode, please share it with a friend, like, subscribe to wherever you get your podcasts, and let's get into it. So, Andrew, take us back. What made you first get into real estate investing?
So it was a couple of things for me. I really was passionate about real estate. You know, I don't know if you guys ever read the book Rich Dad, Poor Dad.
Oh, yeah.
My wife and I loved kind of motivational books and how to make money. And as I was going through college trying to find myself, I thought someday I want to own some rental properties. And, I was in the thick of my graduate program during the crash of 2008. But I still loved houses and always wanted to get into it. So my first opportunity came up in 2011 when I decided to go for it. And it's not just like that I wanted to because of passion, but I don't know, Nate, you know me. I want some control over my investments, and I felt like I could do that with houses. As you mentioned, I'm a chiropractor, and my kids can't come to work with me every day. So I wanted a hobby that I could do with them, actually, because that's one of my fondest memories with my dad is working side by side. He was a small business owner. So I wanted that experience. And last, I know this sounds kind of cheesy, but I have a lot of pride in making a home for someone because I know how much it is for me, how much meaningful memories I make there. And I thought, what a great way to give back to society as a whole. If I have good rental properties, then people make a lot of great memories there. So those are kind of my reasons.
Yeah. On our last podcast, Derek and I talked about how you gravitate towards what you're good at. And I think if you have a passion about what you're doing, obviously you have a passion about your day job as a chiropractor, but I think that it obviously extends into your rental properties as well, because just the visual appearance of them, you take care of your properties and you do a good job. And actually, this is a funny story because we were a couple minutes late starting this podcast. One of the reasons why is you actually had a mishap at one of your properties.
Yeah, you love that text in the afternoon. Hey, I think there's a little plumbing issue. And I thought, oh, it's not a big deal. I'll go tonight. And then I show up and it's a little bit more than I was thinking. And then I realized what time it was to race back here to do this. But, that's like any job has its ups and downs. And I guess I got to the point where it stopped bothering me because I just realized it's the name of the game. But there's months where I just am excited for the first of the month where I haven't been there in 3 months and I keep getting paid every month. So, but when it rains, it pours. That old adage is very true. And I've been up to my elbows in plumbing for some reason. That's what's going on right now with my houses.
So, are you mostly focused on single family real estate or multifamily? And do you do any commercial real estate or is it just residential?
So just residential right now. So here's kind of my story. My wife and I said, okay, we want to get into real estate. How do we do it with the least money possible? I just got out of grad school and my wife and I worked our way through undergrad. So we didn't have a nest egg. We didn't have a bunch of cash to put down on a house. So we said, well, let's just buy and live in our first house. And I'm very risk adverse in some things. And so I said, well, how about a duplex? Because if one tenant's there, at least they're covering the mortgage. And if the other tenant's there, I'm making a profit. That sounds pretty good. Where if I have a single family, no one's paying rent, I'm paying the rent. So we decided our first investment property would be one we lived in. So we bought a duplex, lived in the up floor, and remodeled the first floor. And then when that was too tiny for us, because it was a small starter, And I could get you guys want some prices just to kind of understand what it was for me.
Sure.
Yeah, absolutely.
Yeah, so again, I hit the height of the crash. We're just trying to come back, and this duplex in Cleveland, Ohio, was $79,000. The bank wouldn't even appraise it for that; they lowered it to $76,000. Was our first purchase, and so right now it's probably valued at about a 115 to 130, depending on who you could sell it to. I've done some updating for sure on it, and but yeah, and then like from there it was like, okay, well, we're too small. Let's buy another duplex. So we bought a bigger, nicer duplex that we moved into. And then we've lived there for a few years strategically because we're able to buy, get these rental properties at a lower cost. When you buy my third house was my single family that I live in with my kids and my wife now. And then my fourth property was also another multifamily, but that's a true investment property where now you're paying 25% down. So that you got to save up for. So, yeah, that was kind of how we grew slowly, and that's how we all own multifamily properties. Because for me, it made more sense. Now, it comes with its headaches too, right? But I think for me, it was perfect. It fit my risk category just well.
You're a full-time chiropractor.
Mm-hmm.
How many hours would you say per week or per month do you spend on your properties?
Okay, that's a great question. So there's always like my wife does all the financial part because we decided also that we wanted to manage our properties. There's two styles, right? You can hire a property management company. Some people are very hands-off, which is a great strategy. And sometimes I think because I'm a managing property owner, there's some downsides to that too, right? Like I'm investing my time and effort when a true investment is when it works for you and you don't think about it, right? Mm-hmm. But I decided, hey, you don't want to be hands-on. And my wife likes to be hands-on. She does the financial portion, spends probably 1 to 3 hours per month handling financial issues. I probably spend on an average, well, it's tough. Like, let's just say maintenance, probably 5 hours a month at the most. Now, some months it's nothing, right? Some months it's a lot. But if I want to do a remodel, I might say, hey, I'm going to dump a few weekends and I'll hire a few other extra people to come help me. And then I'll spend like, once a year on I might spend 40 or 80 hours on one unit, but I'm trying to update it to get a higher return on my investment there. So, but like just maintenance, it's very minimal, which is cool. That's why I have a hard time paying that 10% monthly fee. It's just that's the stingy guy in me. I'm like, why would I pay someone 10% just to collect rent when I can do that?
Right.
So
I wanted to go back to that first deal for a second.
Yeah.
So I actually find myself in a similar position that you were in, where I think I've read a couple books on real estate, and I kind of got bit by the real estate bug, but definitely Rich Dad Poor Dad was one that I read. So the question that I would have is that first down payment. How were you saving the money for that down payment? Was it just in cash? Were you just putting money in a savings account, or were you using stocks, bonds, and other investments to fund that down payment?
So, it was just cash I had saved because, I was new out of school. I was 2 years out of my program. So I was just working at a private office as like an associate doctor. So you're scraping the barrel to try to make a living because you're just whatever comes your way. So we're saving up cash. And I was trying to run some figures before I called in today, but literally, what's 3% down on $76,000? It's like $3,000-ish. That's all I had to save for that first investment. Which, when you look at how much return I get on it over the year, it's incredibly low threshold to get into because I did it this way. So when I first bought the property, the down unit was $650 a month. The other way around. The down unit was $600. The up unit was $650 because it was a little nicer. After we've remodeled and just the natural increase in rent because of time and inflation, my rents are both $900 per unit, and it's a 1-bedroom, 2-bath on each level. Okay, so it's very small. It's for grad students or new families that are going to be here for a couple of years. So you're thinking they cover their own utilities minus water and sewer. I pay every 2 years a rental fee. Out of that $1,800 per month, the water and sewer is about $250 if it's a really bad month. So I'm walking out of there that's every quarter. It's the $250, right? So I still have notes on all of these properties. There's different ways to do it. Some people say, you got to buy them cash out, so you have no note on it. But I didn't have the cash to do that, so I said, well, I'm just going to let them pay my mortgage. So my mortgage on that property is about $800 a month. So out of $1,800, I've got $1,000, and then I've got a few $100s in bills. So I'm walking out of there with $800 every month cash flow. Not to mention they're paying down my note.
Right, yeah.
As a general rule for new investors, what would you recommend that they set aside for continued maintenance on the property?
Yeah, so you always want to have a reserve of, it's hard. For me, I was thinking big expenditures. And again, I'm still learning too. I can't say, even though I've been doing it for 10 years. Because I have my day job, I don't invest all this time and effort I'd love to do. So it's a lot of trial by fire. But I love to have that $5,000 to $10,000 mark, because what if you need to replace a roof?
Yeah,
That's septic tank, right? Depending on what 2 weeks ago, one of my units had a plumbing emergency where the pipe, the house is 120 years old. This beautiful part of it's called Little Italy here in Cleveland. They used old steel pipes back then in concrete, and it broke right at the valve. So it's nothing you can do about it. So, you get a plumber in there $2,000 later. So I had to have $2,000 right then. Okay. Mm-hmm. But that, again, those are those rarities. Those are zebras. Horses are things you can count on, right? You're going to see them all the time. So you're going to see, someone's going to lose their keys, and you're going to have some maintenance there. Someone's going to have a broken this, that, or the other. It's a very minor expense. You're always going to have some utilities, unless you own single families. Because even if you own multi-families, apartments and or commercial, there is common utilities and things you have to manage to pay for. So there's a lot of horses that you can guarantee and count on. So it's really easy to plan ahead. But I always wanted that $5,000 to $10,000 buffer. But I didn't have it in the beginning. I just started putting it away, so I would have it.
So, just going back to down payments, you said you paid 3% on that first house, and then the last one you mentioned, you said 25% down.
Yeah.
Do you have any recommendation as far as sort of the opportunity cost of cash, where you could put 20% down and your payments less, but then you forfeit a lot of that cash that could be put maybe into other investments? So what do you kind of look for? Do you look for the increased down payment? And then you also mentioned the method where you just buy the cash outright, but then there's opportunity cost with that as well.
I agree.
Maybe you could touch on that for a second.
So it's very individual. Okay, if you need a place to put your money in a safe environment, it actually, in my opinion, it's a very safe investment. Even though you had the crash of 2008, if you look at a house that crashed in 2008, it's succeeded its value at it was at that point now. And we're only 10 years, or I guess by now we're 12, 13 years out. But to me, that's not very long when you look at what a stock does over time either, right?
Right. We always talk about that as well.
Or if you sit on gold, or if you sit on any other really safe investment, your growth is minimal too. And I love the idea of a tangible asset. And I love my control. So when it comes to value in cash, I chose to buy my houses by sacrificing a little of my own personal time, because I was like, I don't want to spend 25% down. I want to spend as little as possible. And then that way I can keep the cash and put it into another property. That's why I was buying the ones about every 2 years is what I've been buying one at. And the only reason I haven't bought another one is because I think the market's a little inflated right now.
So do you think that increases your risk by doing 3 or 5% down rather than 20 or 25%?
For sure, because I have no margin, right?
Right. Yeah.
But again, I also have, I have that to grow over time. Okay. And they're going to pay it off for me. So at the same time, I'm like, okay, if I had $5,000, or let's say I had $20,000, and I want to put it where I want it to grow over the next 30 years. My mind's eye is like, I have to put that in a retirement account because I get to be more conservative. It's got to sit there for a long time. Where with my house, if I get sick of it, I can sell it, take the equity back out, and do something different. Okay. And it's not going to, especially in most housing markets right now, we're not having this giant surge like we are right now in the market. So I'm not like, crap, what's my house valued at today? You know, is it going to depreciate by 30%? No. I mean, it might go up, down 5% every given year, but it's stable, in my opinion. It's a very safe bet. So if I dump cash into it, I've got more equity, I have more I can do. But also, once you put 20,000 or 20% or 25% into a house, unless you sell it, you can't get it back out. So at the same time, you're tying up your cash. So I really liked the lower for me to pay. And yes, there was a couple of fees you have to incur, like mortgage insurance, right? So because I didn't put a bunch down on my other houses, you have mortgage insurance. But there's ways to creatively get around some of that I really like. Listening to other people, that's one thing I did a lot of. I listened to a lot of other podcasts who that's just all they talk about. And there's so many great ideas out there that are safe to do. Let me tell you about my second deal, and I'll give an example why.
Yeah, great.
So I started working for a major hospital system, and I started by learning just about my job, that there is incredible benefits that sometimes we don't know about because we just don't know. And they have actually offered something called a 0% a loan on a home because I was a physician for this hospital. So I said, I wonder if I can do that with a duplex. So I called the first 5 banks that recommended, and 3 of the 5 said, no, because you're not living in a single family, we won't do it. But the 4th bank I called, I talked him into it. I said, well, I'm going to live there. It's nice. You know, it's like a single family. What's the big deal? And he's like, okay, we'll go for it.
Nice.
So, yeah, right? So my second deal was even better than my first deal in the fact that, so my first deal was $76,000, tiny duplex. My second duplex was much bigger, and it was $202,000. But I actually made money on the closing. So you put earnest money down when you purchase a house to say, you know, you want to buy it. So I put the earnest money down, and then we'd also agreed that they would pay the closing costs. So by the time the closing happened, they had to pay me back my earnest money because I had a 0% loan. And they had to also pay the closing costs, which then came back to me in the form of a check because just the way it worked out. The title guy was like dumbfounded, as was I when we saw all how it broke down. But I share that story only because I'm not a genius and I just figure this out. I just share that you have to dig and find solutions. Like I could have given up on the first bank and not bought another duplex because they said no. But I kept hunting and I found the bank who was willing to do it. And I was so grateful that one of my coworkers told me about the program that my hospital did. So your company, your job you work for, or the city you work for, may do something special. And let me share one more caveat with that because I'm in the process of refinancing my third rental property because I bought it at like 5.5. You'll notice you won't be able to get as aggressive rates when you're buying rental properties because they know they can you want to buy it, so they're like, yeah, we'll make you pay more for it, which is fine. I get it. They got to make money too. But because it's in the city of Cleveland, which is a depressed economy, I found out that my refinance, which is typically like about $3,500 to $4,000, and again, they usually won't give you any reduction in price unless you're a homeowner, right? They may cut you a deal when you're refinancing and you're a homeowner. But rental properties, they know they got you, so they won't do it. But because it's in a depressed part of the city, according to some of the new Fannie Mae rules, that bank has to carry so many mortgages in a depressed city. Right. And so they know I'm good at what I'm paying, so I'm lower risk client to them, but they're willing to pay all my closing costs. So, wow. Yeah, I'm like, so there's, yeah, right. I'm going to go from 5.5% down to 4.4% over the life of 30 years, which is fantastic. I'm saving that percentage, and not quite a half, but 1.5% or 1.25%. And then they're paying all the closing costs. So it's like, but you gotta ask. You gotta do your due diligence. I didn't know what that meant for a long time, but that just means when they say do your due diligence is ask a ton of questions, then ask some more, then be really annoying, and then you usually get what you want.
Yeah, just so it's almost like they're just trying to get rid of you. So
and then you know what? It's because partly they don't even know. They don't even know. Mm-hmm. The mortgage guy that I'm working with right now didn't know about this program. So I said, no, I'm not interested when we first started talking. Then, small world, but a friend of mine who's in that bank, she knew of the deal and said, oh, you know Andrew Bang? That's so cool. We're friends. And then she called me just to say, how's your banking experience? I said, oh, I tried to work with your mortgage guy, but he couldn't help me out. And she said, well, let me take a look at it. And then he calls me back, oh, I'm really sorry I didn't know about this deal, by the way. And so now here we are. So, yeah. And I think this is true when you start working with property management companies. You gotta call 5 of them to get the best deal. And you gotta be a lot of questions. And same with if you self-manage. This plumbing problem I mentioned to you guys a couple weeks ago, that cost me $2,000. I was quoted $20,000.
Wow. Jesus.
Yeah. He said, oh, I got to replumb the whole house. And I was like, no way. I'm like, I'm not doing it. He's like, there's no other option. I'm like, yes, there is. You got to think of another one. And he's like, no, there's not. And I'm like, I know I'm being a jerk, but I'm not paying $20,000. Give me another solution. There's not another solution. I'm like, we got to call another guy to come in here. And so we're waiting about 45 minutes for his buddy to come give me a second opinion. I'm like, well, why don't you try that? Why don't you try that? Why don't you try that? And I know it's being real annoying, but he finally goes, oh, maybe we could do that. And he's the plumber for the last 15 years. Right. You know?
Jeez.
So, yeah, I mean, like with houses, it's fun. It's fun, too, because it's living and breathing. A stock, I have no control over. I love stocks. I own a bunch, but it's like I can't call in and say, we should try this. We might make an increase on our profit. Yeah, where if I'm creative, I can make more money out of my properties.
Right. So I think we kind of touched over something there. Like how important is networking when it comes to the game of real estate? Because you mentioned through your connections at the banks and by knowing all these people, you can get some advantageous situations. So even in relation to your chiropractic practice, like just touch on how important networking is in that space.
Oh, sure. I think that term, it's not what you know, it's who you know. I mean, that is so true. Like it's so quirky of a term, but it is so true. And I think this is one of those things that you talk to people about. You mention it, every little thing. Because what happens is you start unbeknownst to you, you create connections inadvertently. And then those somehow work your way. When you're always talking about it, oh yeah, I own a duplex and so, and you talk about it. Guess how I've gotten a grip of my good renters? By referral. Because I'm people at church, my friends, I have rental property. So guess what? When they meet someone else who says, hey, we're moving to the area from out of state, do you know anyone? Oh yeah, a friend of mine I go to church with or who we play basketball with, he has rental properties. So that's 2 of my renters right now. One's a dental student. He came from out of state. He's here for 4 years. That's a wonderful renter because they have student loans. They have guaranteed money to pay every month. They typically don't want to destroy your house because they want good credit when they leave. And then the tenant above them, same thing. He's here at one of our music colleges. So because I had known other people, they were referred to me. And that's how you grow, man. This is a very, it can be a very hands-on experience. But it's fun too. I have friends who only own single families. One of my friends, he owns 30 properties. Wow. He has someone else manage them. He just nothing to do with it. And it's a different style and it's cool. It's different. But that's the fun thing. You can really take this which way you want to go. You're not put in a box.
Andrew, with most of our with most of our investment portfolios, we do include some real estate in them. We own that through what are called real estate investment trusts, which are publicly traded companies. that purchase real estate. But with rental properties, investment properties, there is one definite advantage to that, and that is the ability to depreciate the property over time. I believe the current schedule is you're allowed 27.5 years that you can depreciate that property.
Yes.
Are you able to speak to anything about how that may help with the cash flow or reduce taxation on your rental income?
Oh, for sure. Now, again, I realized I like to do a lot of projects on my house. I've done a ton of remodeling, but you also need a team. I have a lawyer. I have an accountant that are very good. And then I use people like Nate. You know, I mean, you and I've bounced ideas off you. Like, what about this? Is this the best way to spend my money? Should I buy another house or should I buy something else, you know? So I think you got to have your team. So I do have a very good accountant who's done a lot of real estate, my tax work. But I understand that we use this depreciation to secure more additional funds for me, okay? And so I knew that my job, it's a W-2 job, so they want to take a lot of taxes from me. So that's also part of my strategy behind using real estate to begin with. How do I shelter more of my income? How do I get more of my income? You work with your accountant. You do legal things to utilize all kind of services that are rental, but also help come off your taxes. So like when I lived in a duplex, when I have a lawnmower or I purchase lawn care services, half of those lawn care services are totally tax deducted because it's to maintain the duplex. So then, like, if I would have owned the house myself and I'm paying, $200, $300 a month in lawn care services, it's now half that. So it's like my lawn still looks beautiful. Someone else is doing the work for me, but I'm only paying for half of it. And that's kind of like you start to figure out, okay, what other things can I write off? Oh, my wife does all of our screenings for tenants as well as all our bills. So all my internet, my computer, my phones, all of those things that are all essential for me to do this business are now a tax deduction. And I just make sure my accountant knows what I'm doing so that she can say, yes, 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 yes. No, you can't do that. We don't want to get in trouble. That's stupid, right? Why work so hard for this to lose over something so dumb? But there's so many great tax advantages to use, and you just use the professional so you don't miss any. You could try to do it on your own, I suppose, but you might miss something.
So Nate, maybe you can touch on this as well, but you mentioned all the tax benefits that come with real estate, which is one of the reasons it interests me so much, because even if you own like a real estate investment trust, you don't get all those tax benefits that would come with being a real estate investor or having your properties under an LLC. So do you have your properties under an LLC or do you own them individually?
So, great question. This is one of my areas that I need improvement on. So my attorney reminds me very often, why are these in your name? You need to get them out of your name. And we'll think of my strategy, right? These were bought by me personally because I was living there. So right. In the beginning, it made sense to buy it with my wife, as my wife and I on the deed. I was in the process a few months ago of trying to combine all three of my rental properties under one umbrella and turn that into a commercial loan. That's a strategy you can use to you combine them into one loan, one payment. You can usually remove some of the equity via cash, then use that cash to buy another property. So I was going down that pathway because since I bought my homes in my personal name, to change them to an LLC usually is not a problem. You just have to let the bank know, and sometimes they want to be annoying and they can do what's called call the loan due. And then now you have to come up with cash or get a new loan, and it can be quite a process. But it's definitely, when it comes to you're protecting yourself, it's the smart thing to do, and that's on one of my to-do lists. But yeah, so since I couldn't combine all three properties, I need to go through that process of working with my attorney to get them into LLCs.
Yeah. And Andrew, we've talked about this before from a risk management point of view. The LLC is definitely something that can separate the properties from your personal name. Mm-hmm. But I would recommend to a new real estate investor that if they're buying multiple properties, at least in the beginning, sometimes if it gets too large, then it becomes too much paperwork. But I would potentially separate the insurance policies on those different properties. And the reason why is if we have a roof blown off on one property, well, that insurance claim doesn't affect the insurance on the other property. Whereas if we have all those properties under one policy, potentially one claim on one of them gets added on or surcharged on to the other properties as well. But Derek, you were mentioning, we invest in real estate investment trusts. That's how we gain exposure to real estates through our investment portfolios. And that has some advantages and disadvantages to real property. Definitely one of the advantages is that I can sell that right away, right? If I wanted to sell my real estate investment trust today, this afternoon, I could do that. But the real estate investment trust pays dividends, pays high dividends, but those dividends are taxed at ordinary income rates. So we don't get the benefit of qualified dividends. So as we just mentioned in depreciating the property, there is a serious benefit to owning real property because of the depreciation and the ability to kind of shield some of that income from taxation.
Yeah, I know when my attorney and other attorneys I've talked to and or listened to, when you're setting up LLCs, they typically recommend that you set up one per unit because you shield them from exposure, right? If you had 3 properties and I put them all under one LLC, Andrew LLC, and one of my tenants sues me, all of my 3 properties are now liable to be in that lawsuit. Where if I had one LLC and they sued me from that one, a second and a third, they could only attack the one LLC, that property. So that's definitely usually what I've been told I need to do when it's time for me to do it.
Yeah. Essentially what you're doing is creating a series of firewalls so that suit can't get into the other properties.
Exactly.
So before we get off the topic of taxes and stuff, in my research, I heard something about like 1031 exchanges where you can take the capital gains from one property and roll that into another property without paying that tax. Is that something you take advantage of?
Well, I haven't yet, but yes, I would. A friend of mine did that, and it was phenomenal. I mean, they made $80,000 on their. They bought, early in the 2000s. They held it until 2 years ago. Made about $80,000 on it, and then they were able to roll that right into another property. It's like, wow, that's just such a fantastic way to grow. Now, the only thing you have a small window. You got about 4 months. You have to sell and purchase your new property within that window. So the only negative side is you don't have time to shop and really know. And you got to make sure if you have a deal you like that you either have put some earnest money down, but then you have to be able to sell your other property at the same time.
Right, yeah.
You make your money when you buy the house.
I've heard that. Yeah.
Do you understand why that is?
Right. Yeah.
Because you set up for the sale, right? If you get a good deal there in the beginning, you set yourself up for the sale.
You set yourself up for the sale at the end of your exit plan, the cash flow. I mean, it's got to be, you've got to be thinking ahead. So I tell people, because trust me, you start talking about this, guess what? Everyone wants to be into real estate. And I have a couple of friends who've done that because of that. But they're like, oh, I missed a deal. Oh, and I'm like, you know how many houses are out there? You never feel like you lost a deal. It's okay. There's always another deal. And so that's the other thing. It's like you start learning, you start watching, and you start even throwing some bids out there as your education. Unless you can get a mentor. That is by far the best way to succeed. If you have a friend, relative, or some people even, they do pay mentors. Some do. And it's if they help you miss out on a lot of this stuff, the hard knocks, it can be very helpful and can project your growth a lot farther ahead if someone's looking at the deals with you. The problem is finding one. It's incredibly hard to find one. But if you know someone that is offering, I'd take them up on that.
So how many hours do you think that you spend prospecting, looking at potential new deals?
Hey, Nate, do you mind if I ask you a question off what we just talked about?
No, go ahead.
I was just going to say, we talk about, quote, missing the deal a lot about stocks too, where you hear these stories where Like these stocks will go on crazy runs, and you feel like you missed it. And it's like the thing you don't want to do is try to chase the gains. It's like if you're patient in the market, those opportunities will present themselves. And I always, Warren Buffett has a great quote where the stock market, it's no called strikes, where you can just watch pitches go by until that one perfect pitch comes by. And yeah, you'd be more successful. And that's also goes into like leaving emotion out of it, because I feel like there's a lot of emotion and you're not operating on rationality and logic.
Yeah,
Sorry,
for sure.
That's,
Do you want me to comment on that? No, it's
no, we can just go on. Just want to add that.
No, I think that's a great point because, I mean, so many mistakes you make as investors are made because of emotion, that fear of missing out going in for it. And you're right. I always tell that to people too when my clients are calling me up, and they call us for different reasons. Anything financial related, they'll call us just for someone to bounce an idea off. And if they're buying a car, they'll say to me, well, my salesman says if I don't buy this car now, I'm going to miss out on it. Like, there's so many cars on the road.
Why would he say that? Because he's trying to make money on that deal.
He's trying to make a sale, exactly.
Yeah.
And that's no different with a real estate agent, typically, And we talked earlier about really questioning. Sometimes you have to be annoying to your agent. You just have to prod and just continue to push. You do it nicely, of course, but you just go so you get that deal. And you have to be unemotional about it. On my first deal, I told you the bank wouldn't even appraise the house at 79. They only appraised it at 76. And my agent's like, you should just pay the extra $3,000. I was like, no, I'm not going to. It's not my fault. The guy who bought the property before me didn't look ahead. I mean, like, you can't feel bad for what someone else did. It's not like I meant to hurt the guy. I'm not hurting the guy. But you have to also look about, like, you have to make a good deal too, or you don't buy the property. So you have to, you do have to remove the emotion. He was getting emotional with me. Well, this guy is too bad for this guy. He's losing out on this house. I'm like, I'm not emotional, but if the numbers don't work, the bank says it's not worth that much. Why would I buy it underwater already? It's not a good deal. So I have to unemotionally connect. I feel bad for the guy. Sure, emotionally on a human to human, yes, but it's just the way it goes. Yes, it's all numbers. You just put in the numbers. If they work, great. If they don't, then you move to the next property.
In the world of real estate, they often refer to, a real estate investor might refer to the number of doors that they have, which often refers to the units that they have, right? Mm-hmm. Is there a goal that you have as far as what you're trying to accumulate before maybe you are in, quote, retirement age?
Oh, for me personally?
Yeah.
So I'm at the point now, I have to change my strategy if I want to do more. I'd love to, I love my current job a lot, but I would love to work less just because, everyone's looking for how do I spend more time with family? How do I have more work-life balance, right? I think that's most people's goal in life. And that's another reason my wife and I chose to do this, because we feel like it can offer that to us. So for me to get to that would be quite a few more houses. I mean, I have a large family, so I have a lot of little tiny mouths to feed. I don't have a specific number of houses, but what happens is if you self-manage like I do, you get to a point where you can't do more. You have to either hire people to do it for you, or you have to quit the job you're already doing, since I have an 8 to 5. So if I want to keep growing, and my wife and I came to this realization just over time, like we're at our limit, because even though I only have 3 units, I actually have 14 units, because in my newest property, it has 10 individual spaces, and then my 2 duplexes are 2, right? So that's technically 14 individuals I'm working with. So it's like owning 14 different houses, right? It's a lot.
Right. It's a lot.
So we've decided either when our youngest kid is in school and my wife has more time, guess what? We can buy more properties if we want. Or we say, you know what? It's ready to transition into the property management company, where we step back and we use some of the income to fund that, to pay them, and then we don't get as much cash flow, but we're not also doing anything.
Scalable too.
Yeah, exactly, scalable. So, but I can't. I have loved doing it this way because I know the game, because I'm in it. When the property management company calls me and says, "Oh, they say we're gonna have to replumb the whole house," I know exactly what I'm gonna say. No, you're not. I want a better solution. So I think
But yeah, if
that's
somebody went through like a sorry, I didn't mean to interrupt you, but
no, go ahead.
if you went through a property manager, like you wouldn't have the boots on the ground experience where you would know whether
Yeah.
somebody's trying to take advantage of you.
And of course, I think they have your best interest at mind. I do think
Oh,
that,
sure.
you know.
Right. Yeah,
but
right.
I'm telling you, man, nobody loves your stuff like you love your stuff. Nobody cares about your money more than you do. So don't let someone pull the wool over your eyes like they care about your properties more than you care, because they won't. So you got to fight for your stuff, you know.
Sure.
Andrew, one of the reasons why I think you're perfect for this podcast is you have a little bit of everything as far as investments. And I'm not going to get into that specifically, but you have a day job that you work. And with that, you have traditional retirement accounts.
Yeah.
And you've got other savings accounts and investment accounts that you do on the side. And you've got real estate. What is the process for somebody who's looking to maybe kind of duplicate what you're doing, where they're not a full-time real estate investor, but they want to get into it and they want to add real estate as part of their portfolio? What would you foresee as the process that you eventually, will you hang on to these properties in retirement years to draw the income off them, or will you systematically sell them off as you need to fund that retirement income?
Yeah, well, I mean, that's the fun thing. It will depend on the market. That's the beauty. I love the house because it's like, let's say we hit another 2008. What do I care? The rent's not going to go down. My property value might go down, but rents didn't go down, did they? No.
Right.
And even if they go down a little, you have a whole year to plan that out because you have these locked-in lease rates that the tenant is paying. So if my house lost half its value, it's not like the rent goes down by half its value. It stays the exact same. Okay? So I could collect. But let's say the market's high like it is right now. Oh my heck, I could sell all those properties and put my money into something else, like a beach house in the Bahamas, right?
There you go.
So
There you
I
go.
will just I have the luxury of doing whatever the market's doing to my advantage. So I do like that. And so I don't think about the future with my houses because I don't know my exit strategy at this moment. It will depend on the market. So what I would tell someone who is like how to prepare to get into what I do, you have two paths. You can either say, okay, I live in a house and I'm planning on moving. Consider keeping your current house as your first rental. You know that house so well. You know when something leaks, you already know how to fix it. You know where to tell the plumber to go do, or the electrician, or you kind of know all the ins and outs. Like each house is like a person. Like I know all the little ins and outs of these properties I own now over the years. Or the second thing is you need to create like a fund. Like Nate, you're starting to help me create a fund because a lot of my money's tied up, but I take a little bit of money every month and I put it into stocks and bonds that I can sell if needed to do something with, right? Mm-hmm. And you talked to me off the ledge the other day. I said, maybe we should close it out, and you said nope. And this is why I think having a team is so important, because you reminded me why I did it, because I'd forgotten for a second there, and I'm going to use that money eventually to buy another property because it's just sitting there, takes money out of my account every month. I don't even think about it. And then occasionally I'm like, oh yeah, I have money hidden away that Nate's working on for me. And then in 5 years, when my wife has our youngest in kindergarten, and she's like, okay, I have free time. What do we do? Guess what that's done for me for the last 5 years? It's grown. I'm ready. So I think that's the way to approach that. Is you learn. If you don't want to buy and keep your current house like I did, if you want to just buy a rental property outright. You need to save for that. I mean, there's no other way to get to it. Maybe you guys have other thoughts.
No, I think your answer about when I asked you what you planned to do in retirement, and your answer was, I'm going to let the market dictate, tell me what I'm going to do. I look at, for somebody who is in retirement years with their investment portfolios, and that's the reason why they own stocks and bonds and gold and cash and real estate, is because when we need to withdraw that money, rather than being forced to sell something maybe at a bad time, you're not forced to do that. You're able to let the market come to you instead of you having to chase the market.
Yep.
I love that.
Yeah, me too. I just feel like I have, again, I can't go back to enough to talk about the teams. I've always wanted to do real estate, but I had someone teach me in the beginning. It's actually the person that introduced me to you, Nate. It was Matt. And he talked about you create this moat around your property, because it's like, why would you work so hard just to have everything taken away from you? So we started with like the protection and the insurance, making sure I was covered there. Then we started to build the retirement vehicles. Then I like some whole life insurance because I want protection, because I had some life experience that said, I want that. So whole life insurance was important to me because I have kids to fend for because of some, and I saw some personal experiences where a family member died and they didn't have insurance, and I saw how hard that was. So I was fearful for me. Well, guess what? I don't fear that anymore because I have that set up. And then I was like, well, how do I keep growing? How do I protect my taxes? Okay, my houses. And it's like you just add layer upon layer, a little at a time. Like, I have a little bit everywhere. It's like the ultimate diversification. Doesn't matter what's happening. I've got something growing for me somehow.
Nate, what's that analogy you use where it touches on that, where you just get harder, or it's more and more difficult to take you down, basically? Don't you have an analogy like that fits really well?
I don't know what the analogy is. I mean, I always, the way somebody like Andrew has it set up is, I always say, nobody is truly bulletproof, but we're about as bulletproof as we can get because we have this diversification here and we have these layers of protection. And you have different way these assets are going to be taxed. We've got different ways these assets are going to grow. And I just think that the way it's set up, that it's about as healthy as a financial planning can get.
I wanted to ask about, you said most of your, or maybe all of your properties are in the Cleveland area. Is there anything specifically about that location that you find the real estate environment is either friendly, or stuff you don't like about that environment in Cleveland?
Oh, yeah, great question. So in one of the books, the many books or books on tape I listened to, someone said, buy in your backyard. I know, I live in Cleveland. I know Cleveland. I know what's going to do. And so, I was never comfortable buying out of state. I'm like, I don't know that city. I mean, right. It could be in the economic turmoil, and I'm like, oh, this is a cheap house here. Well, yeah, because the whole city's tanking.
Right, yeah.
Right?
Buy some New York real estate right now.
Oh, my goodness. I can't imagine. And it's every big city.
Sure, yeah.
They're leaving, and they're making every other normal city expensive. But the thing is, I know Cleveland. I know what's going to happen. I've lived here for over a decade, and I knew the neighborhoods. I knew if I bought in this neighborhood, I knew the type of renter I was going to have. Now, I don't discriminate. I love all people, and I will rent to whoever meets my qualifications. I don't care gender, sex. I think it's all great. I'm super happy to rent to a diverse group of people. But when you buy a property, you also have to understand the renters you're buying the house for. And so that can help you. If you know you need to make sure you pick the neighborhood, well, you don't know the neighborhood unless you know the neighborhood, right? You can't just,
right, yeah.
Oh, this must be a great neighborhood. It may be a terrible neighborhood. So I know the neighborhoods I buy in because I feel comfortable with that. It's like a stock, right? A stock that pays dividends. You buy a stock, you should be, because you've read the prospectus. You know the company. You have some passion about the company. You're willing to hang on to the company because you believe in the company. That's me in my houses. I know the neighborhoods. I know what's going to happen. It's going to pay me a dividend. I'm going to be there in the good times and the bad times.
Is there any metrics or anything that you use besides your own knowledge about the neighborhood? Do you
totally
look up statistics about the area? Do you have any resources that you could recommend? Maybe?
Yeah, and that is actually what I meant to pull up all before. But can I tout another podcast? Do you mind?
Oh, yeah, go for it.
Okay, so the podcast, because there is a ton of them. And usually the podcast you start to listen to, in about the first 5 minutes, you're going to know if it's worth listening to or not, because they're going to start to sell you on coming to one of their classes. Okay, I hate that.
Oh, right.
That means they give you crap information or a teaser and don't really teach you anything, and you just waste a bunch of time listening to their podcasts. But I found a podcast I really like. It's called Bigger Pockets.
I've listened to that one.
It's the best one I've ever found because they interview tons of different types of people, tons of different properties, and they do sell some books, but I've never had to buy any of their books because they teach you everything you need to know in the podcast if you want to learn about it. So there's tons of formulas and statistics, and they teach you how to set up. So all I did was I would listen, oh, that's really interesting. And then I would make my own spreadsheets. And I'd listen to other podcasts. Oh, I should add that to my spreadsheet. Boom, 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 add my spreadsheet. And so it was like a combination of hard numbers, and then and then the intangibles, I guess, is knowing the neighborhood. Is it intangible information that you can't learn on a spreadsheet, right? because
Right.
sometimes the numbers work, but you're like, this is stupid. Why would I buy in this neighborhood? It will forever be hard for me to sell or leave, or there's, this, that, and the other. But I knew you got to have a formula. So listen to websites or go to podcasts like that. They have a website that shares tons of formulas, and you just kind of take what works for you. This percent rule, this law that seems to work really well, and then you come up with your sheet that works for you. So yes, you have to use those, or you're just guessing, or it's emotional, 100% emotional.
Right. Yeah. I feel like the less information you have, the less empirical information you have, the more likely you are to act emotionally. That's been my experience with investing in stocks.
100%. 100%. Yeah, that's the due diligence. That's what that means, right? Actually having figures, numbers, and data. And that's everything from how is this a walkable neighborhood? What kind of person do I want to rent to? Well, let's see, a dental student, like this house I rent to, I've had surgeons, fellows who are residents, dental students, and another professional student. He was master's program. So I know it has to be close to the college. That's a huge major university. It's safe, and it has a yard, because guess what most of those people have? Small children.
Mm.
Okay. Guess what? I don't love to rent to animals, but guess what most of these people have?
Animals.
A small dog.
Yep.
Or a cat. Because if they're just a husband and wife, they have a small dog because they're not ready to start a family yet. Or guess what? How many babies have been born in my duplex? Not in it, but
Yeah, right.
because so they need a small crib, nursery room. And so I knew all that. I'm like, if I buy this house, this is the type of renter I'm going to get. And guess what I've gotten every time? That type of renter. So that's another thing. That's an intangible you got to figure out.
So here's a good question that kind of segues. How do you go about finding tenants? Do you do any marketing or just word of mouth? You mentioned word of mouth. What's your process for finding tenants?
Of course, word of mouth is fantastic, but there's some great programs out there. One of my favorite is called Zillow Rental Manager. So we're all aware of the Zillow program, right, where you can look up house values and stuff like that. So they have a rental manager program. You can sign up for free. You create listings for your properties, and you list your property for a very reduced rate. It used to be free, but I think it's $10 a week. It's insanely cheap. It gets posted on Zillow, Trulia, and HotPads. And every once in a while, I'll post on something like Craigslist. Or if I want to really focus in on the college students, I might post to that college or hospital system. They all have their own little housing section. You have to pay a little bit more for those, but it can be definitely worth it. And that is the best way. I'm never putting up a sign, never once, in front of my properties. I think that can be wise in the right housing area, but I'm always pre-planning ahead, okay, this person's moving out in 3 months, and I know people are going to be looking to move for school around that same time, so I'm putting these on those listings 3 months in advance, saying they're available in 3 months. So I've never actually had to put up a sign because I've always had it usually rented right away.
Wow. Yeah, that's awesome.
Andrew, have you ever had to evict anybody?
One time.
Can you kind of maybe go through that process?
Sure.
Without naming names, right?
I should go get my wife, because I had to send her to do it because the courts are only open when I'm at work. So that poor lady, my wife, she's a champ, man. I love her. Oh, maybe that's another thing, caveat before I answer your question. I think having a business partner, it's very challenging to find the right business partner that you'll really click with, and you have to have each other's best interest in mind. And my wife and I only fight. We're pretty good when we're actually remodeling together. So we try not to be there at the same time. But I think she was fantastic. She worked with our attorney to figure out what needed to be done. Now, a lot of times in some cities and states, your attorney must represent you if you own an LLC. You must be represented by an attorney in the court. If you own them privately, like we did, we could self-represent. So my wife said, well, I'm going to self-represent, but my attorney told us all the forms we should fill out, and there's a lot of them. You have to pay some court filing fees. It's about $120. And And then there's two different court dates. One court date you first show up, where they set a future court date, which that's actually like a resolution more. You're not even talking to a judge at the second court date. The first court date is like, is this even legit? Okay, yes. And the plaintiff and the defendant, they come together. Our defendant never showed up, so it was automatically awarded to us for the second court date. And then when that tenant showed up, my wife just stuck to the lease. When the tenant said, no, this is what I agreed to, my wife said, I don't know who she kept saying, well, Andrew said this to me. And my wife said, I don't know. All I know is what it says in the lease.
Right.
And that's what you go by. Because unfortunately people, they come on hard times or they are dishonest. That's not true in all things, but the best case scenario for those who are going to run this process is to offer them money to actually leave.
Oh, yeah, right.
Yeah, and
The
so
universal
funny.
language.
Yeah, because what happens is, and I tried this because I heard the strategy, and even my friends who own rentals, they said, dude, you got to just give them cash to leave, because first of all, we lost 4 months in rent because the process takes so long, and the $120 filing fee, and utilities that they didn't pay either, because the way this rental unit worked out, we paid utilities. Anyways, so we're allowed to collect this money from this tenant, but good luck finding their bank information because they just changed their bank, and you don't know how to collect it. But we have 20 years to figure out how to get the money from them. But yeah, so best case scenario is if you can offer them enough cash that gets them just to leave, because then like if they don't pay rent after 3 days, you're allowed to put what's called a 3-day notice on their door, where it says that, hey, you're in breach of your contract. You have, 72 hours to pay this. There's usually, each city has an appointed time you have to give them to make the payment after you've given the 3-day notice. There's a lot of legalities you got to follow. And if you don't do it right, guess who loses? The owner. Yeah. So we worked right with our attorney to make sure we weren't screwing anything up, and we documented a lot of things he told us what to do, which was great. It's that vital team component. But yeah, I mean, even at the attorney fees, I wasn't even thinking of too, that when you run into one of those things. So if you know your tenant's not going to pay, you're like, okay, you start low and you just kind of work up. You try to get them into a spot, and they most of the time don't know this, right? So you have a bit of an advantage just kind of coming in with some knowledge. But that's why you screen. The better you screen, the better your tenants are. And things like Zillow Rental Manager has a great screening tool that you can do that the tenant actually pays. So I don't even have to collect money to pay for it. They self-pay when they put in an application online. And then, you make a very non-emotional decision to rent to a tenant or not to rent based off what you get in your screening process.
So if you could walk me through one last question, I guess, for that.
Sure.
So let's say that you have a tenant that applies and some red flags come up and you realize that you're not going to rent to that tenant. Tell me about that process. Is it just...
You just say, it has to be as benign as possible. We've chosen to go with, you've not been accepted. Let me see, what was the term we used? Your application has not been accepted at this time. Thank you for your time. That's it.
Straightforward, yep.
Yep. And I'm sure, and I don't know how someone would go about saying you discriminated against them. That's why if you leave it as bland as possible, you'd never want to, because it's very easy for me to say, well, I don't want to rent to an older person because X, Y, and Z. I don't, but like anything can become just, so you can't, even though I've chosen to try to rent to people who have small children and who are going to college or grad school, I like that. I won't, if I get an older person who qualifies, I will take them, because you don't want to be stuck in that boat where you're accused of that. So making sure that you're giving everyone a fair chance is always what you want to do. But yeah, if it's a red flag because their job isn't, like, it's good, credible reasons, their job history is not there long enough, or they have outstanding debts, other debts that they're not paying, so you're going to get lumped low in the totem pole, the utilities are not being paid, or in the past, those are red flags you don't want. Or if you think they're like, I don't know. I'm trying to think of other big red flags that we've had. Anyway, I don't know. I kind of got off on a tangent, but
No, it's perfect.
yeah, your big take homes are that's got to be a non-emotional decision because it's all based off the screening process. And I will maybe one thing that they don't screen, I will request a phone number for job verification. And then you call their company, and that either does two things. First of all, you can't ask much, but you can ask how long they've been employed there and if they're employed there. Okay? But those are huge because one of two things happens. Your tenant's scared and they won't give you the number and they just drop off, and you know they weren't going to be a good renter. Or two, you call. No, really, it happened one other time.
That makes sense. Yeah, right. Yeah, it totally makes sense.
Some guy's like, "Oh, I've been working there like 5-6 years, all this stuff," and I'm like, "Okay, when can you give me their number?" "Oh, I don't know it." I'm like, "What company do you work for?" And then like I tracked, right? And you can. It's not very hard to look it up, where you say XYZ company and employment verification. It's through HR department. So it's actually pretty easy. Once you call, every HR department knows what you're calling about. So it's not like, who is this? Why? You just say they're going to rent from me. I'm just verifying their employment and how long they worked there for you. And that saved me probably from this one tenant that would have rented from me because everything else looked good on the sheet. So, so if their employment's not very long, sometimes that makes me nervous too. So I'll say I'm rejected off that.
I had a few topical questions because with the stimulus packages that were passed because of COVID, there was the moratorium on evictions where owners weren't allowed to evict. Did you run into where you could delay rent? I don't know the fine print in this. Did you have any run-ins with that?
Thank heavens the one person we evicted was February 2019.
Oh, wow.
I was like mid to end of February. I was like, thank you so much. I was so grateful that they had left, because there was, unfortunately they had not given us a lot of rights when it came to as the owner. It's interesting. People think if you own properties, you just are instantly wealthy. It's like, no, I still.
And
it's
also like the language surrounding like owning property, it's almost like there's like a negative connotation where you're like a landlord. It's like I just never understood that. It seems it seems like there's a bad rap.
Yeah. So I think I gotta say this is one of the benefits of being a self-owner at this time in history, or self-manager, excuse me. I talk to all my tenants, and I really try to think of them like, okay, they're living at my house. I want them to enjoy it, like have great memories of their college life, and then they're living at this great place, and we called our landlord, and he would actually fix stuff for us, and so we try to keep a very open relationship. I go over, hey, how you guys doing? What do you need? Is anything broken? Today it's Sunday night. I don't want to go over and fix a plumbing thing, but I literally went as soon as my tenant called me because I want to make sure they know I'm on their side, right? So no one didn't pay during this whole COVID thing for me. And so I'm grateful for that, but I think part of that's because they know I'm a person and I care, and they see could I drive a fancy car? Yeah, but I don't. I drive a beater because I put all my tools back there. So does that show I'm a human guy? Yeah, I'm wearing a freaking ripped pair of jeans and a dirty collared shirt, but they see me like that, and we talk and chat, and they know I work for the hospital, but I think they realize I'm just like them, and I'm not. I'm trying to make it just like they're trying to make it. And I've had some tenants call us and be like, hey, we can't pay rent right now. Can you give us an extra week? And I think if you try to look at someone like, this is like how my sibling could be, or my parent, or what if I was like this? How would I want them to feel? A little compassion goes so far. Right. And it's like they figured out ways to pay, And we've just tried to be 100% honest with them. Sometimes it's a little bit of tough love. Like one tenant called my wife, said, hey, I can't pay. And he said, listen, you signed the lease. We have a fee after 2 days of late payment. Are you sure you can't borrow the money from someone else and then pay them back? Because he's like, I'll get the money in a few days after. And so you try to set a boundary, but you're trying to be kind, but you're also creating a boundary for this person to say, it's not okay that you don't pay rent on time. You agreed to this. You got to stick forward with that. And so that helped. And this person hasn't come back, and he paid, which was great. You just try to help work through that process. It's crazy, the relationship you're trying to create, but still keep really solid boundaries. And I think it went a long way during COVID.
It's like give an inch, take a mile, where they kind of like enjoy,
Yeah, but
they push that boundaries back.
They do push it, but like I think also that interpersonal relationship, I'm sure, did some good during COVID because people kept paying, and I was super happy for that because we're like, oh no, moratorium, what? So,
well, Derek, any more questions out of respect to Andrew's time? Is there any topics that maybe or any questions that we missed that you think we should ask?
I think this was a really good podcast. I asked the bulk of the questions. Maybe if I think of something else, we could have you back on the podcast.
Yeah, it'd be fun.
Absolutely.
And I didn't even get to do like the fun part, like where we like said, this is how much it costs every month. This is how much cash flow there is. This is how much. That's almost more fun when people see that. And they go,
I was actually
oh
gonna.
Goodness.
Yeah.
So,
I was going to ask a little bit more about the numbers because I'm a numbers guy, but yeah.
Sure.
I mean, if you'd like to come back, yeah, we could totally talk about that.
That'd be fun. And what that would do is I'll give me some time to like actually, I'll try to do it like really. So, cause I do hate when there's anonymity, when someone says, oh, my cash flow's like so for instance, if I say my one duplex is 900 and 900, 1,800 a month, that's not really true. I mean, I have the note, water, sewer, and then like some other small things. And so like getting like real specific, because I think be honest is good. You need to make sure, like, okay, I love Rich Dad Poor Dad, but you don't become a millionaire by owning homes unless you own like 300 of them. Okay.
Right.
So I thought in the beginning when I first started, I'm going to be a millionaire like Rich Dad Poor Dad. And I'm like, oh, so you make like $5,000 to $8,000 a year, but I'm like, holy crap, I'd have to have like 100 of those to be a millionaire. Holy crap, that's a lot of work. I don't want to do that. So I think being realistic is also good, So
I feel like within the space of real estate, there's a lot of, especially like on Instagram or YouTube, like it's almost the incentive is to be as flamboyant as possible. Where you're like, I turned 50 grand into 4 million in 3 years, like these crazy numbers, and that's just the name of the game in society now. Everyone's looking for the get rich quick. But I agree with you.
Robert Kiyosaki got rich off his books.
yeah, exactly.
No, it's true. Right. And then he bought more properties. He brought more properties, which is great, but he didn't get rich off properties. He used that as a vehicle. He realized you can make a lot of money, and you can. But he used his books. He made a bunch of money off his books, and he just buy more properties because he likes real estate. That's the same with most guys. They're trying to sell you on, I flipped all these properties. Well, they make all their real money off the classes they want to. Yeah. And I can't tell you how many people I've met. Oh, I'm a real estate investor. I'm like, oh, cool. How many homes do you own? I don't own any, but I just spent 20 grand and took this course, and I'm going to buy my first one. And I'm like, wow, you should have spent that 20 grand.
on a property. Yeah.
That's the downside of what we're dealing with. A lot of people want to take advantage. So,
yeah. I mean, we try as hard as we can with the stock side of things where we're like, this is not a get rich quick podcast. No. This is a do the homework, wait 20 years until the investments pay out. Like get rich slow. We're a get rich slow podcast.
That's super good. I love that. That's the truth.
Well, Andrew, thank you very much. This has been awesome. And I think our listeners have gained a lot of information about real estate investing, especially the ones who are on the cusp looking to get into it. I think we've talked about the benefits of it and also some of the pitfalls that come with it as well, as any investment will have.
Yep.
So let's consider a date. We will have Real Estate Investing Part 2 in the coming weeks, and we'll get together and kind of go through the cash flows and the purchases and the specifics of this property.
It's the exciting part that makes you actually want to buy it.
Do you have anything you want to plug or let the people know about anything?
No, I just want to plug you guys. I've worked with Nate for many years now, and I think knowledge is power, and I love the age of technology we live in because you don't have to go to college and get a background in real estate to know how to do this. Literally, you can have your 8 to 5 like I do and still do this, and it's enjoyable, and it's very fruitful. You get to be right part of your investment, which you don't always get to with some of the other vehicles. So no, this is great. I love your guys' stuff. I've listened to a bunch of your podcasts too. I learned from you guys, so thank you.
Oh, that's awesome.
That.
Thank you. Yeah.
And I would tell you, Andrew, I appreciate working with you. You're the type of guy who is a can-do, positive attitude. I mean, look, you just came back from a plumbing mishap, and you're talking about real estate investing with the same excitement that you had. I think that's fantastic.
Yeah, well, thanks.
Well, Derek, why don't you take it away for us?
As always, if you like the podcast, follow us on Instagram to get clips from the episode at Dynamic Growth Pod. Like and share wherever you get your podcasts, and we'll see you guys next week.
Remember, Crosby Advisory is a registered investment advisor in the state of Ohio. At any time, you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Keep in mind, investing involves risk, and you should carefully consider all risks and fees before making an investment. Crosby Advisory is also a licensed insurance advisor. Insurance products are sold and serviced through Crosby Advisory.